6 p.m. Central African Time. We begin here this evening. Nigeria's Dangote Petroleum Refinery has begun pricing fuel products for the local market in US dollars. A company statement cited difficulties securing sufficient crude under the government's Naira for Crude program and rising global oil prices. The Naira for Crude program, which was launched in October of 2024, allowed domestic refiners to purchase crude in the local currency, as well as reduced pressure on the foreign exchange market. Commentators say that the development marks a major shift in the refinery's commercial operations and could reshape pricing dynamics in Nigeria's deregulated downstream petroleum sector. For a perspective on this, we joined on the line by Calvin Chisanga, an economist based in Zambia. A very good evening to you, Calvin. Good to have you with us. Welcome to Africa in Business.
Thank you so much, Ngudweni. Thank you so much for having me once more as well.
So let's try and put this all into perspective. How big an issue is this announcement, really?
Well, the Dangote Refinery decision is something that is aligning to commercial realities that is on the ground, especially at a point when we are looking at pricing or matrices that are basically aligned with the crude oil in the global market. Obviously, the pricing of refined petroleum product in dollars reflect a deep implication that is actually taking place with the commercial shift, which also has an implication for downstream in Nigeria itself, as well as also covering the wider African continent. From the economic perspective and standpoint, obviously the decision reflects a currency mismatch, which is quite a very big problem in the case. But again, also, if you look at the global market, oil in particular, in terms of crude oil, internationally, it's priced in the US dollar, and which is largely also purchased in that currency form. So meaning the refinery could have been selling a product domestically in Nigerian naira, obviously under the arrangement that they made with the government. But again, there could have been some exchange losses that were incurred from that perspective, especially when you look at the Nigeria's and Nyla's, dominated the pricing benchmark. So this basically becomes a bit of a challenge, which may expose the most of the refineries, like even the Dangote's situation, may be running at losses and can even actually face a financial uncertainty if we are not pricing with the some levels of predictability. So the pricing in dollars clearly aligned with the revenue or avenue of production cost, as well as improving the financial stability of the refinery plant.
Could this also, Calvin, be an indicator of sorts about Nigeria's foreign exchange market and perhaps the country's macroeconomic environment? Does this shift signal anything regarding this?
Well, for Nigerian case, yes, looking at the current situation that they have cultivated in terms of the positive macroeconomic environment, there are a lot of complications that can actually be able to be highlighted. But of course, the implications are more complex to the core, because the Naira for crude oil program, which was introduced in 2024, may have disadvantaged a number of key players in the market. And what we are seeing working out here is that it's a situation where we're now going to create a demand for foreign currency, which will be able to interplay in terms of trying to bring that crude oil in the market, and as well also going down to the refinery or retail pricing that will be benchmarked there. The issue that was actually put in place in terms of trying to support Naira purchase of crude oil, which actually in two parts, because Nigeria has got two elements here. The elements of importing some elements of crude oil which complement to the domestic crude oil which they have. And again, also maybe just to cite an example, the pressure will be quite massive, and it can destabilize a number of key economic factors. Actually, when you look at the inflation patterns, which have actually been working out very well from that perspective. And again, also in the essence of trying to support the Naira, currency, it would destabilize, domestic fuel pricing matrices as well, because obviously the oil marketing company there they may tend now to force looking for US dollars so that they can meet up the demanding pressure that will be able to be built up from there. And again, this potentially distort the performance of the currency itself, because what will happen in the local markets that the more we have high demand for dollar, the more we start depreciating the naira, from that perspective. Meaning at the point now, depending on the exchange movement in the case, this will translate now to higher cost of fuel in the end, because obviously the aspect of dollar, that effect of demand will be able now to pass on to the transport cost, and will have also a repercussion to the broader line of inflation pressure from that point.
As we've highlighted earlier, Calvin, the Naira for crude policy was really introduced to reduce foreign exchange pressure on Nigeria. Does this move suggest that this policy has actually failed?
That's what it implies actually to say, because that policy was basically mainly made to support the naira and stabilize the domestic market. So with the outturn that we are able to see, so this also brings a lot of things in display, meaning we're now shifting the demand for US dollars in the market, and that also brings a different situation. Maybe a typical example is what we have seen, experienced in the last 2 months. That's May and June. Nigeria was importing about 40.4 million of barrels of crude oil, and what we have seen in terms of expenditure is about 4.4 billion US dollars, meaning even when it comes to reselling that crude oil, or rather defined oil, they have to make a recap, meaning the business has to undertake profit margins based on that. So it has to stand comparatively to what is happening from that perspective. So meaning the term adjustment that is taking place in import should be able to be reflected with some profit margin from this end. So that brings the country in pressure in terms of trying to balance up the actors. And this now brings the local currency with that effect, where we can actually be able to say that it start depreciating, because the demand for dollar will be quite elevated from that point.
So, could this decision then perhaps encourage a greater dollarization in the Nigerian economy? And if so, what long term consequences might this have for the economy and for investor confidence, as well as monetary policy?
Okay, so in the first place, the policy, the action which is taking place with the demand for dollar will defunctionize the monetary policy mechanism, meaning it will not be able to work as it is intended to work, even through the central bank point of view, meaning we can now escalate the high spikes of inflation in the case, because once we start looking for dollars to meet up the demanding nature of the domestic market, even much more the wider perspective of the regional market, meaning from an African perspective, also it can affect some of the key, importers of crude of oil from Nigeria, which actually becomes a very difficult situation, because what will happen now is that will not be able to strengthen the energy security in that region, and that also brings a distortion to the supply reliability aspect. Meaning, what we should be able to see also that the broader aspect will be a structural challenge that we can actually be able to see, where Nigerians, they will be facing a challenge which will not be able to give a positive balance of payment. And in the case now, what will be able to happen is that it will affect a number of key macroeconomic variables, starting from the credit capacity, for SME. It also affects a number of other things to do with the purchasing power, where we will be able to see that inflation will not be able to be anchored with an expectation. And again, it also comes to a broader range of what is happening also, because again, it's a two-way factor here. Dangote is fighting for profit to be sustained and also to create that predictable environment. Then on the other side now, to create a pressure on government is target line on policy, as well as also affecting the consumer pipeline from that level as well.
So we've discussed then the potential macroeconomic implications of this. Let's focus on the implications of businesses that are heavily reliant on fuel, for example, those in manufacturing or even the transport sector.
Yes, so there will be a cascading effect in the industries as well. That also now speaks into consumptive demand, because obviously when the industry are hiking up, there can also be a situation where the pattern for consumption will be affected. And in the end, now what we'll be able to see that some companies can even now start laying off some of the workers because they've got high energy costs, which is not moving things on the ground. And again, the whole implication here is that it will be critically very difficult for some of the key elements to be working right in shape. And mind you, as I mentioned, when you link the cost of doing business, it all comes back from all these angles. And we understand that energy is a basic factor which plays around production and meeting up also the aspect to do with transport, meeting up electricity issues and all sort of things, because there are some elements of electricity generating power which are using diesel for them to actually produce power. And again, the key aspect of also looking at the whole entire aspect of what energy is doing. So the energy policy, as I mentioned, of 2024 is pretty much linked to the currency interplay, which was actually structured from there. Meaning, what we see is that the energy in Nigeria is the largest weight in terms of US dollar use. So those issues will now be able to double the effort from that point, meaning we'll be able to distort the whole entire market around these energy issues, because we see what is basically happening that Nigeria is even started exporting aviation oil into Europe. So that alignment also, it's like a competing element that is taking place right now. The domestic market, suffering from some of these effects, and again also the outstanding market, which is right there in the overseas. So that also is something that is going to work out from there. So meaning, it can also distort the continent's dependence on foreign exchange capacity. Mind you, Nigeria's got high level of consumption, and even when it comes to interplay around industrial activities, it's quite huge. It's one of the giants in the continent.
I'd like to round off with just this thought, Calvin. There is an argument that Africa needs to start selling oil to its neighbors outside of APEC. What does this move indicate? Is it pushing the idea further away?
Well, as I mentioned, for the African perspective, the refinery of Dangote remains strategically important because it's a saving element for some of the regional players in that region, even much more with our case where Zambia is, South Africa is. We are exploring options to get from Nigeria so that we can actually mitigate some of the distance that we have, where we get from Middle East and many others. So as we speak right now, the capacity for that is something that we are actually be able to see that it can work out for Africa. So the industry that Dangote has set up, it's meeting the expectation of the continent, which basically can also be able to play out a critical element for us. Like you can even see that Kenya has also gone the same way, where they're saying we need to have a replication of the similar refinery plant in Kenya, meaning it can also feed up from there. So meaning if we can have a situation where we are having some stability in terms of how we go about currency interchange, that brings a difficult situation for us to even champion the African Continental Free Trade Area. That also becomes a challenge also to see that the energy security around the region can also be cannot be guaranteed from that perspective, because the exchange market can sometimes become volatile. So it's not something that we can actually be able to depend on. And we know that dollar shortage and the external factors can also interplay from there. So it's a quite a very delicate balancing that need to be underplayed with this aspect.
Thank you so much.